All right, so get ready because today we are going deep into that Robinhood 1099B form. The one you've been looking at with a mix of like curiosity and maybe a little bit of dread, especially if you've been, you know, right in that Tesla wave in the market. And let's be real, when it comes to taxes, we just want to understand what really matters, right? We don't want to get lost in all the jargon.
Absolutely. We're going to cut through the noise and highlight exactly what you need to know, to confidently tackle your 2024 taxes.
Perfect. So let's break this form down section by section. First, we got to talk about the very important distinction between short-term and long-term transactions. They're separated on this form for a reason, and it all comes down to how Uncle Sam wants his cut.
Exactly. Short-term means you held that investment for 1 year or less, and long-term, well, that's anything over a year. Now, since you've been actively trading Tesla, I'm guessing you have a lot of short-term action happening. And that's where things get interesting because short-term gains, they're taxed at your ordinary income tax rate. So let's say you made $10,000 from a quick Tesla trade and you're in that 22% tax bracket. Well, you could be looking at a $2,200 tax bill on that. Ouch, right?
Yeah, that does kind of sting a bit. But what about those long-term gains?
Now, this is where the government gives you a little break. Long-term gains are hit with a lower capital gains rate. It's usually 15% or even 0%, depending on your income level. So on that same $10,000 gain, you could save yourself a big $700 in taxes just by holding on to those Tesla shares a little bit longer.
Okay, that's a pretty good reason to maybe think twice before hitting that sell button too fast. But how do we figure out exactly how much we made, or lost on each trade? I'm thinking that brings us to those proceeds and cost basis sections.
You got it. Proceeds is just the total amount you received when you sold the stock. It's like the sticker price. But to really know if you got a good deal or not, you need to factor in your cost basis, which is essentially what you originally paid for those shares, plus any adjustments like commissions or fees.
So it's kind of like figuring out your profit margin, right?
Yeah.
You got to know what you paid, this how much you really made. But I've heard some bad stories about the cost basis getting messed up, especially when people transfer shares between brokers. Have you run into that?
Oh, absolutely. It is so crucial to double check that Robinhood tracked your cost basis accurately, especially if you transferred those Tesla shares from another brokerage. If those numbers are wrong, your tax liability could be wrong too, and not in a good way.
All right, so let's say we got our proceeds and our cost basis all figured out. How do those actually translate into gains or losses on the form?
Well, it's a pretty simple calculation. Proceeds minus cost basis equals gain or loss. Pretty easy, right? So if you sold Tesla for more than you bought it for, congrats, you have a gain. But if you sold it for less, well, then that's a loss.
And I'm guessing all those individual gains and losses, they all get added up at the end of the year?
That's right. They all come together, and they give you your net short-term gain or loss for the year. And that number is really important because it gets reported on Schedule D and Form 89 and 49 of your tax return, which ultimately, affects how much you owe, or, fingers crossed, how much you get back.
Okay, so we're starting to see the big picture here. Each trade matters, but it's the overall net gain or loss that the IRS is really looking at.
Exactly. Now, while we're talking about losses, have you ever heard of this thing called a wash sale? This is where things can get a little tricky, especially for active traders like yourself.
Wash sale. Yeah, I've heard that term before, but to be honest with you, I'm a little fuzzy on the specifics. Could you break it down for us?
Of course. So imagine you sold some Tesla shares at a loss. Maybe you panicked when it dipped or something. Then just a few days later, you buy back into Tesla because, let's be honest, you can't resist.
Well, my friend, that's a classic wash sale. You sold at a loss and then repurchased the same stock, or something that the IRS considers substantially identical, within 30 days before or after that sale.
So it's kind of like the IRS is saying, nice try, but we're not letting you claim that loss if you're just going to buy right back in.
Exactly. They see right through that. So what they do is they disallow the loss for that year, and then they add it to the cost basis of the new shares that you just bought. It's not gone forever. It's just deferred. But it can definitely change your tax situation for the current year.
So if I see a W on my form or an amount in the wash sale loss disallowed column, that means I can't claim that loss right now. You got it. And honestly, wash sales, they happen all the time, especially for folks who are, actively day trading a stock like Tesla.
Yeah.
It's something to be aware of because it can really make a difference in your tax liability.
Okay, that's definitely something to keep in mind. Now, besides wash sales, are there any other little surprises hiding in this form?
Well, there are a few more codes and footnotes that you might see. Don't let them scare you. They're mostly just there to explain, adjustments or disallowed losses. But if you see something that you don't quite understand, it's always a good idea to just talk to a tax professional, just in case.
Good to know. So we've covered short-term versus long-term gains, the importance of cost basis, those tricky wash sales, and some additional codes. Anything else we should be aware of before we move on?
Yeah, one last thing, and it's a big one. At the bottom of the form, you'll see the totals for your proceeds, cost basis, and net gains or losses. They're usually separated for short-term and long-term. Those totals, those are the important numbers that you'll need when you file your taxes.
So that's what we're really reporting to the IRS, huh? Like the bottom line of all of our trading.
Yep, that's it. They want the big picture, not every single trade you made.
That makes sense. Well, I know this might seem like a lot to take in, but don't worry. We're about to talk about some practical steps you can take to make this whole process a lot less intimidating. Stick with us, and we'll make sure you're ready to conquer those Robinhood taxes.
Okay, so let's actually talk about how to, put all of this knowledge into action, because staring at a 1099-B with all of those numbers, it can feel kind of like you're trying to crack a secret code.
Oh, yeah. Tell me about it. I'm getting a little overwhelmed just thinking about having to put all of those trades into my tax software.
Well, good news. If your form says covered, it means Robinhood. They're reporting all of that stuff directly to the IRS. So if you're using tax software, you can usually just import those totals for your short-term and long-term gains and losses. You don't have to go line by line.
Okay, phew. That is a huge relief. But what happens if my form says non-covered?
If it says non-covered, you're probably going to have to do a little more work, like double-checking your cost basis information, maybe looking back at your brokerage statements or your trade confirmations. It might even be a good idea to talk to a tax pro, especially if you had a lot of complicated trades.
Got it. So even if my form is covered, it's probably still a good idea to look it over, right?
Mm-hmm.
Just to make sure everything looks right.
Oh, for sure. It's always smart to just do a quick review and look for any really obvious mistakes. For example, do those totals for your proceeds and cost basis kind of match up with, your overall investing for the year? If something seems way off, you'll want to figure out why.
That makes sense. Like a gut check to make sure you're at least in the right ballpark.
Exactly. And while you're at it, you should really pay attention to any big amounts in that wash, sale, loss, disallowed column. Remember those losses, they aren't gone, they're just pushed out so they could, affect your taxes later on.
Speaking of wash sales, you mentioned before how they're so common, especially for people who are actively trading. So I was thinking, are there any ways to kind of minimize those wash sales and maybe save some money on taxes?
That's a great question. It means you're thinking strategically, which is what we want. One thing you could try is trading in a different sector or industry, for a bit if you have to sell something at a loss. So like if you take a loss on Tesla, maybe you could explore something like renewable energy or tech ETFs for the next 30 days instead of just jumping right back into Tesla.
So it's about finding opportunities in different parts of the market to, keep things moving without running into those wash sale rules.
That's the idea. You want to be aware of those 30-day windows and look at other investments. And hey, diversifying is always a good idea anyway. It helps spread out your risk, and you might even find some new opportunities you hadn't thought of before.
That makes sense. So once we've, looked over our 1099-B and maybe done some planning to avoid those wash sales, what's next? Where does all this information actually go on our tax return?
Okay, that's where Schedule D and Form 8949 come in. Schedule D, that's the main form for reporting all your capital gains and losses. Your short-term trades usually go on Part 1, and then long-term trades on Part 2.
Okay, so Schedule D is like the main stage for all of our trading. But what about Form 8949? Where does that fit in?
Form 8949, think of it as the detailed breakdown, like the itemized receipt for all your trading. It gives more specific info about each trade. Your tax software might need this form to be attached to Schedule D, especially if you had a bunch of transactions during the year.
So it's like Schedule D is the summary, and then Form 8949 is like the backup documentation.
Exactly. Now, before we go on, I want to really emphasize that the main goal is to accurately report your total short-term and long-term gains or losses to the IRS. What they care about is the big picture, the final result of your trading, not the tiny details of each little buy and sell.
So it's not about giving them too much information. It's just about giving them a clear and accurate picture of the overall gains and losses.
You got it. Now let's talk about some more advanced tax strategies that might be helpful for you as an active trader. Have you ever heard of trader tax status or a mark-to-market election?
Trader tax status, mark to market. Those sound kind of intense. Honestly, I'm not sure I'm ready to dive into all of it.
I hear you. They are definitely more advanced. We won't go too deep into them today, but if you're doing a lot of day trading and it's a big part of your income, it might be worth learning more about. They could give you some pretty big tax advantages.
Okay, so maybe a little research is in order. But for now, let's just stick to the basics for handling this 1099-B. What are the really important things our listeners should remember?
First, you absolutely have to figure out if your trades are short-term or long-term. That's going to determine how they're taxed, and it can make a big difference in what you owe.
Right, because those long-term gains have that nice lower tax rate.
Exactly. Next, it's so important to double-check your cost basis. Make sure Robinhood's got it right, especially if you've moved shares between different brokers. If something's wrong there, you might end up paying more taxes than you should.
So double-checking that cost basis is definitely on the to-do list.
Absolutely. And you forget about those wash sale adjustments. If you're hitting those a lot, try to find ways to minimize them and maybe keep more of your profits.
So it's not just about understanding the forms for this year. It's also thinking ahead to how our trading decisions might affect our taxes later on.
You got it. You want to take a big picture view of your investing strategy and make sure you're thinking about taxes too.
I like it. Okay, we have covered a lot of ground, but before we wrap up, I want to go back to something you said earlier about getting help from a tax professional. When should someone think about doing that?
That's a really good question. If you're feeling lost or confused by any of this, don't be afraid to call in an expert. They can give you personalized advice and make sure you're not missing out on any deductions or credits you might be eligible for.
So it's like having a financial expert to guide you through those tricky parts of tax season.
Exactly, especially if you did some complicated trades or had a lot of wash sales, or if you're thinking about those advanced tax strategies like, trader tax status. Having an expert there can really give you peace of mind.
I totally agree. It's worth it to make sure you're doing things the right way. Okay, so before we let our listeners go, is there anything else you want to add? Like any last bits of wisdom?
Just remember, knowledge is power, both for investing and for managing your taxes. The more you know about the rules, the better decisions you can make, and the better off you'll be financially.
Well said. Okay, everyone, that wraps up our deep dive into the Robinhood 1099-B form. I hope you're feeling a lot less intimidated by this form and maybe even a little more excited to tackle those taxes.
Me too. And remember, we're here to help you on your financial journey.
Absolutely. A big thank you to our expert for sharing their knowledge and to all of you for being here. Don't forget to subscribe to The Deep Dive for more deep dives into all sorts of complex topics. See you next time. Okay, so before we wrap things up, I want to go back to those advanced tax strategies we talked about earlier, the ones that are especially relevant for frequent traders. You mentioned trader tax status and mark-to-market elections. Could you give us a quick overview of what those are and why someone might want to look into them?
Sure. Let's start with trader tax status. It's basically a special designation from the IRS that says, you're trading stocks frequently and it's your job, not just something you do for fun. And if you qualify, you get access to some pretty nice tax benefits.
Okay, like what kind of benefits? Because nice tax benefits sounds pretty good to me.
Well, for one, you can deduct all sorts of trading-related expenses that regular investors can't. Things like your home office costs, software subscriptions, even like education expenses related to trading. And probably the best perk is you can choose to use this thing called the mark-to-market accounting method.
So mark-to-market, what is that all about?
Okay, so it's basically a way of treating your trading activity like a business, for tax purposes. So instead of calculating your capital gains and losses at the end of the year, like when you sell, you basically mark your positions to their market value on the last day of the year. And this can be a huge advantage because it lets you deduct losses even if you haven't actually sold the stock.
So you can offset your gains with those unrealized losses even if you're still holding the stock. That sounds pretty powerful.
Yeah, it can be, but it's important to know that qualifying for trader tax status, it's not super easy. The IRS has some pretty strict rules, like how many trades you make, how much time you spend trading, and even your intent to profit. You should definitely talk to a tax professional to see if it's something that makes sense for you.
Got it. So not really a do-it-yourself kind of strategy. Probably better to have an expert help you out with that one.
Exactly. Now, one last thing I want to leave everyone with is this. Don't be afraid to try different trading styles and strategies, especially when it comes to, keeping your taxes low. We've talked about ways to avoid those wash sales, but there are a ton of tax-efficient investing strategies out there, like tax loss harvesting, investing in tax-advantaged accounts, and, maybe exploring some different asset classes that have different tax treatments.
So it's not just about being a tax-smart trader.
You got it. By being, proactive and strategic, you can keep more of your profits working for you.
Love it. Well, I think that's about all the time we have for our deep dive into the Robinhood 1099-B. I hope everyone's feeling more confident about tackling those taxes and maybe even a little excited to explore some of those advanced strategies we talked about.
I hope so too. And remember, the more you learn about investing in taxes, the more confident you'll be as you, manage your finances.
I totally agree. A big thank you to our expert for sharing their knowledge, and thank you all for listening. Don't forget to subscribe to the Deep Dive for more explorations into complex topics. Until next time.